Okay, good morning, ladies and gentlemen. Welcome. Hello, please come in. And welcome to the second year of the CE Sustainable Finance Summit here in the beautiful premises of the Mandarin Oriental Hotel. And my name is Julian Toth. I'm the CEO of the International Sustainable Finance Center. This is...
Hi, I'm Zeilina. I'm the CEO of ISFC, or the International Sustainable Finance Center.
Which is the main organizer and organization behind this summit, in which through the next 5 days and through panel discussions and fireside chats and roundtable discussions, we will explore different sides and different topics under sustainable finance. And we will go through policy and regulations, to energy, banking, but also to sustainability in business and all the way to innovation. So there's a lot, and really a lot packed in this agenda we have planned for the next 5 days.
Thank you. I think one of the reasons why we actually created the summit was, well, guess what? When you work on sustainable finance, sometimes you feel a bit lonely. And I had recently a very interesting Zoom call with President Obama, who said that one of the biggest life lessons one should take away is that you should build your own community. So every time somebody asks you, but why? That makes no sense. Why do you run a non-profit? Why do you run a 5-day summit? Isn't that exhausting? So that you actually have somebody to go to and ask and tell them, listen, somebody asked me again, why do we do what we do? And to be honest, this event is one of the reasons why we do this. We want to bring together people who agree. We actually want to engage with people who disagree, because guess what? We don't want to be in an echo chamber. Also, it's a very interesting discussion because there's so many things to unpack. We do need a sustainability transition. We need to rethink our business models, economic models, also how finance works. And for that, guess what? We need almost everybody either on board or engaged. So we really hope that this event will act as inspiration, that you will learn something, that you will meet some interesting people. And if there's one task for today, for those here in person, try and meet somebody you haven't met before. Because I'm sure that some of you recognize each other, but do try and ask, why are you here? What do you work on? And maybe you'll find somebody very interesting. Because we think that there's so much potential in this room. So please enjoy the discussions. And I will hand the mic over to my colleague just to wrap up and introduce our fantastic keynote speakers and the first panel.
And also to mention 2 more things. So I completely agree with what Mr. Obama said about the community, and it's really important for you to, and I think that's why you're here as well, to come and to meet people working on similar topics and maybe sharing similar challenges. But let's not forget about the people online as well. So we do have people watching online where they also should be part of the community, and probably and hopefully will also work closer and meet more people from the circles working on these topics. And you mentioned that 5-day event can be exhausting, and it is a lot of effort to put this together, from the agenda all the way to implementation and actually organizing everything, speakers and the panels. So it's really important to mention that this actually would not be possible without the support from our partners. And there's a lot of partners, and I would like to actually thank them as well. I do have a list. Without this list, that would be very difficult, and I tried to remember all of them. But just to mention some of them, 1 second. So the summit actually genuinely wouldn't be possible and without the support from all these partners, and that's from Erste Group and Česká spořitelna, who have been supporting us very closely, and also Czech Group, the European Investment Bank, Mazars, KPMG, CTP, Citibank, Raiffeisen Bank, ING Bank, SAP, British Embassy in Prague, Allen & Overy, EBRD, Deloitte, Heavy Finance, RSJ Investments, CRIF, Magyar Bank Holding, Visegrad Fund, and the US Embassy. And there's a lot of partners. These partners supported us, the summit, financially, but also with their advice and with their speakers and with their know-how, and we are very, very grateful for the support. And maybe without any further ado, so we can kick off this long and hopefully inspirational summit, I think we can move on to the next block. and already with the first keynote speaker by Marek Havrda, Deputy Minister of the European Affairs, please.
Good morning, ladies and gentlemen. It's my great pleasure and great honor to address the 2023 CE Sustainable Finance Summit. I'm really glad that I've been invited and become a part of this community, emerging community, because more than 10 years ago I started my first job in the European Commission working on sustainability. And I'm really glad to see how the things are evolving. Let me start by thanking the International Sustainable Finance Center for organizing the summit here in Prague. And let me express a special thanks to Linda, who initiated and managed the project from the very beginning, creating a platform for an open and stimulating discussions and sustainable finance in practice. It is obvious that sustainability is and will be among the main factors influencing transformation of the industry and the economy as a whole. In the EU political context, sustainable finance is understood as finance supporting economic prosperity by reducing environmental pressures and taking into account social and governance aspects. As we see also from the program of today's summit, there are many aspects to be considered regarding sustainable finance. In the regulation area, a significant amount of legislation has been prepared in recent years. Taxonomy, sustainable reporting, due diligence, standards for green bonds, just to name a few. Last semester, the Czech presidency made an important progress on these and related files, including the approval of Corporate Social Responsibility Directive and reaching a general approach. This means the agreement among the member states on the due diligence directive, which is very close to my heart, I have to admit. We reached agreement with the EP on the climate parts of the Fit for 55 package and as well on CBAM. We also negotiated with the EP the agreement on European Green Bond Standard, which was finalized by our Swedish friends just a few months ago on the last day of February. The objective of the new finance framework is to bring more transparency and coherence to the system and thus encourage private sector to allocate resources efficiently towards sustainable economic activities. In addition, the regulatory framework aims at creating a better link between profitability and sustainability, helping tackle the short-termism and encouraging long-term perspective in our decision-making. Sustainable regulations are not about bans or outlawing some practices or activities, but rather about motivation, in an effort to find an economically optimal way to maintain a healthy level of investment in Europe in line with our sustainability goals. When defining implementing modalities, it is crucial to avoid greenwashing while striking a good balance when reaching the instrumental quality of information so it allows to make decisions with the minimum possible administrative burden to the businesses. Let me turn to the geopolitical situation, which radically changed last year. Russia's aggression against Ukraine and Russia's energy war against Europe has made it clear that we must eliminate our dependence on fossil fuels from Russia. And this was among the chief priorities of the Czech presidency last semester. Transition to a net zero economy has thus become not only environmental, but utmost important geopolitical and security objective. In order to be successful, we need to secure resilient supply chains for the green transition. However, today the EU is highly dependent on imports of critical raw materials. Therefore, developing strategic partnerships with reliable partners has become a key priority for the EU. Ambitious and agile EU trade policy lies at the center of securing resilient supply chains. Last year, thanks to the Council conclusions approved under the Czech presidency, the EU cemented more granular and tailor-made approach to sustainability criteria in the FTAs, free trade agreements. Besides the FTAs, another major challenge is to implement effectively the EU autonomous sustainability legislation, be it CBAM or deforestation regulation. Today, the EU green industry is also impacted by the steps in the US and China. The Czech Republic therefore welcomes the recent proposals on legislation regarding the Critical Raw Materials Act and the Net Zero Industry Act, which shall help create a more favorable regulatory environment in Europe for net zero technologies and boosting competitiveness of European industry. However, regulatory action is clearly not enough. For the resilient supply chains, decarbonization of the EU industry, as well for development of the EU industry, for the development of the green industry in Europe, it is the private sector which plays a crucial role, with a similar role of the banking sector and the finance sector overall. Sustainability shall not be seen as a one-way or even a formal requirement, but we shall look for an appropriate mix of public and private actions towards resilient supply chains, competitive industry in Europe, while reducing both the negative environmental impact and our geopolitical vulnerability. I believe that the summit will provide new perspectives, inspiration, and insights that will help us move forward towards the shared goals. I wish you a very productive discussion this week. Thank you.
Thank you very much, Deputy Minister Havrda. I think that was a very good opening salvo setting the scene. So if I can pass now to our second speaker. So we will have 3 very short keynote speeches. So if I can now ask Mr. Philipp Aeby to join me on the stage. And he's the CEO of RepRisk, a Switzerland-based company. So please, the floor is yours.
Thank you very much, Linda. I work for technology companies. I was given this high-tech device. Let's see whether it works to change the slides. But before I start, I want to mention that I studied climatology in the 90s of the last century. And when I finished my studies, there was no job for me as a climatologist outside of academia. So I had to go into consultancy. And this is very, very different today. So it's amazing what has happened for the last 30 years. It's also amazing that after seeing these waves of interest in ESG, which, as you know, was not called ESG for the last 30 years, there has not always been basically something backed up with actions. And I really believe, if you think, for example, of the focus on climate, there was a peak already more than 10 years ago in 2011 with this Stern report, if you remember this one. Then there was basically 2015, if I'm not mistaken, there was a Paris Agreement, but nothing really happened on the ground, if I may say so. If you think, for example, of the German car industry, I'm not against the German car industry, I love them, but there was no real impact in terms of the way they build the cars. They were more fuel efficient, yes, but at the same time they gained so much weight, I mean the cars, that basically there was very little benefit of all these efficiencies. But now I think for the last 2 years, things are really, really changing. At the same time, I think when you go back to the coronavirus pandemic and you see how ESG became even more prominent, especially the S in ESG, and then basically that it's still so important despite the war in Europe and the inflation, economic difficulties. It's amazing, but at the same time, since 2022, I have the impression there's a little bit of feeling sometimes that ESG gets a bad name. So why is that? Because there are some promises, there's some pledges, and it's really unclear what the impact is of ESG. I very strongly believe in ESG in the sense that there should be a positive impact on planet and on society. So I'm not talking about the political aspect. If there's a backlash, as it's called, against ESG in America and the US, this doesn't worry me because it means there's an impact. There were no political backlash if there were no impact, right? So that's a good thing. I'm happy about these discussions in these democracies about the ESG impact, but I'm worried that there's not enough impact as it should be. So I think for me as a believer in ESG, I was thinking, what are the things that should be done to accelerate that further? And I know there are in the audience, the people from government, from the European Union, but also standard setters like the GRI. And I was thinking of 3 things I think we should reconsider. I'm not against these things, I just say we should reconsider in terms of the focus we have of them, and 3 other things I think we should have a stronger focus on. So these are the things I think we should reconsider. I start with the middle one. Also, just to be clear, I'm a climatologist. I'm not a climate change denier. What I really mean by this is we should reconsider the approach we have taken over the last couple of years with respect to carbon, and in particular for investors. Because you have this, what some people call this science-based targets, and they basically say, okay, for us to make sure that the temperature is not rising on average above this 1.5 degrees, we should have less emissions, we should transition to zero, and then you can break that down. For example, if you're a so-called universal owner in investing, pretty much all the companies on earth, at least the listed ones, like the Norwegian government pension fund, that you can calculate them basically, so how much emissions are still allowed, so to speak, over the next couple of years for an industry or individual company. This makes a lot of sense. And it's called the science-based targets, but then we do something that is completely unscientific. Because when I studied climatology, the first thing I learned is to think of the climate as a climate system. So if you have a climate system, and you basically break down the carbon emissions for your portfolio companies in your investment portfolio, and then basically you encourage the companies to lower their carbon footprint. What does it mean? It means basically that the companies, and an example, I'm from Switzerland, an example is Holcim, companies sell part of the business, high emission parts of the business, like what Holcim did, selling the Indian business to the Adani Group. Is that an improvement? Yeah, it's an improvement for Holcim, I hope. But overall, if you think of the climate system, there's same amount of emissions in the system. So this focus of the carbon footprint in terms of a portfolio doesn't make sense. It makes sense for individual company because they can lower their carbon footprint in a real meaningful way, but it doesn't make sense at all to have ETFs and measures and metrics, etc., at the investment portfolio level if you don't think of the whole system. Because you push basically the dirty assets either to dirty companies. There have been discussions lately among the coal mining companies where they shall merge part of the coal business, actually the coal business, and then basically have a dirty coal company in New York. And there will be more than enough investors that love dirty coal companies as long as they're profitable. So you push these assets to the dirty company, so to speak, dirty just in terms of CO2 emissions, to be clear, or you put that into private markets where they're somehow below the radar, or you force companies to do pledges that they cannot uphold. And a good example is BP. And I fully understand that BP reassesses the strategy and the CO2 targets, but it's just very interesting to see how the share price went up 10% when they said basically that they want to reduce carbon targets. So I think we should be realistic, and I think if investors want to improve things and if regulators want to improve things, we should go for subsidies. I mean, look at the Biden administration. We should go for a carbon price, or we should go for regulation. We could, for example, say no more coal mines in the European Union or in the UK. I don't make a comment about the UK because I just learned that the UK embassy sponsors the events. But these are policy choices, right? So I think we should spend more energy on thinking about how can we get the right subsidies, how can we invest in technology companies, how can we have the right regulation, and not delegate basically this task of transitioning to a low-carbon economy to the portfolio managers that then basically are like sitting in a bathtub. Imagine two portfolio managers sitting in a bathtub, and the water is a carpet. The tap with the carpet, the water is flowing into the bathtub. It goes up, and then basically the investors say, oh, this is my portfolio, and they take buckets and try to put it into the portfolio of the other guy, right? So this doesn't work. So that's one thing I feel very, very passionate about, that if we talk of science-based targets, we think of the mechanism to really lower the carbon in the system. The second thing, company reporting. I was very, very honest to just meet the chair of GRI. I'm not against company reporting. In fact, because one of our clients just asked us, demanded that we do a sustainability report for the first time in 17 years. We do now the sustainability report. So we have the sustainability committee, we have the diversity inclusion committee, we have great stuff to tell in terms of cloud computing, which is carbon neutral thanks to really great technology. We put everything into this sustainability report. And then, of course, the first thing we do is we share it internally. It's great employer branding, right? All the great stuff we do. We collected it, put it into a report. But what really shocked me was when last week our chief commercial officer came to me and said, "Hey, Philipp, we should publish that report because it's such great marketing." It shocked me because I was basically critical of company reporting and disclosures. I was saying what we need is due diligence. We don't need so much disclosure necessarily by companies, because if you think of corruption and human rights issues and cutting down forests, you don't disclose that for Christ's sake. So we need due diligence, not disclosure. And then our chief commercial officer that works with me for more than 10 years wants to publish our sustainability report. But I understand, it's great marketing, but the fact is we haven't done any action in addition. We just collected everything we did already. Of course, I understand if the baseline, everything, but what I'm saying is it's a huge administrative burden. I mean, for us, it was not a big deal. We just hired someone to do that, etc. As I said, big benefits, employer branding. But are there better ways to get results that really affect the bottom line? And one of that, for example, would be due diligence. The third thing I think we should reconsider is this idea that there's one number that basically determines whether a company is a good or a bad company. These ESG ratings. I'm not against ESG ratings. We talk about it on the panel, so I don't want to go into that. But I believe this ESG rating, despite of this aggregate confusion, it's unclear what it means, very much stems from the fact that ESG ratings are very convenient to use. Basically, if you're an investment manager, I mean, you just can continue with the same methodology, right? You just say, okay, 600 European companies, now go to a provider, tell me what 300 actually are ESG okay, and then you take the 300, do everything the same, and in the end, maybe even end up with the same portfolio companies because there's some overruling policies that you can do. You just can charge basically 50 basis points more. So instead of aggregate confusion, I think we need clear purpose. So what do regulators, legislators want to achieve? And then think how you can achieve it. And then maybe company reporting or ESG ratings are not the answers. I mean, an easy example is diversity. And in Europe, it's different to the US. Here, diversity can be, in terms of metrics, for example, measured in terms of gender. Depends on the legislation. And here you need company reporting, right? But if this is your goal, then basically make a law that you say there's a certain number of, for example, females at the management committee level, at the board committee level, etc. That's easy to do. If it's about, I don't know, if it's about biodiversity, well, that's a tricky one because there's not a simple number and a simple single number like for carbon, right? But you could, for example, say as a European Union, okay, we want to protect wetlands or whatever. You know, there are a lot of methodologies developed by NGOs like WWF to do that, high conservation value areas, etc. But the first thing we need is ESG. Otherwise, it really goes down the drain. Is to be very clear about the purpose of every data point, of every metric, but of every legislation as well. And here, the European Union came up with something absolutely great, the double materiality. In simple terms, what the Americans like to say, you can talk of risk. Is it about financial risk, a certain thing you want to achieve, or is it about impact, and in particular about adverse impact? Related to that, and I'm super excited now in the European Union and the UK, there's now talk about regulating some of the ESG data providers and what the UK calls rating agencies whenever they come up with a score. And when we follow the example of the Japanese, and again follow the proposal of the IOSCO, then basically transparency on the methodology is the #1 thing, because only if you have transparency, you see that things get changed all the time, and this doesn't make sense anymore, right? We need transparency. So that's the other thing that I really urge you to consider as an investor when you buy data, but also as a regulator. And the last one goes back actually when Linda and me met in 2020. We always talk of ESG, but usually we just mean E. Actually, we just mean climate. And I think there's no fair transition to this low-carbon economy without considering the people, the S. And again, it was for pure inconvenience that the S got neglected, because there's no single number. I mean, how do you measure discrimination? How do you measure fair labor conditions? You could measure job creation, but there was no focus on the S. But we need the S in addition to the E, the same way as within the E, not only climate, but also biodiversity, because if you don't have conservation, it looks very bad on this Earth in 30 years as well. And you can only do this E and S if you have proper governance. So these are the 6 things I would love you to consider and reconsider. Thank you very much.
Thank you very much, Philipp. That was a fantastic deep dive into what's right and what's wrong, actually, with the current ESG landscape, and what could be the potential solutions. So thank you for that, and thank you for bringing the S in ESG. We will have a whole session about that in the afternoon. So now I would like to introduce, my privilege is to introduce Mr. Eelco van der Enden, the CEO of GRI, Global Reporting Initiative, which is the world's largest reporting framework used by over, I think, 50 or more thousand companies globally. So thank you very much for joining us today, and please, the floor is yours.
Well, thank you for having me here. And Philipp touched so many topics that I could go on for 3 days in a row in addressing them. Especially the last item, that there is so much attention for the E and not so much for the S and the G. And that has a reason, of course, especially in capital markets. Because everyone understands carbon, that you can reduce that by putting a filter in a factory. I mean, you can imagine. And that's not only that, you can measure it quantitatively and qualitatively. And what's even more fun, you can trade it. It's monetizable. And when it's monetizable, it usually gets a lot of attention. But I'm not there to discuss this. So I made some scribbles, and I have my chief of staff that will stick me to my 10 minutes, I hope. But sustainability and sustainable finance are important. And why are they important? And why do they get so much attention? Because you cannot run a profitable business in a dysfunctional society. And whether we like it or not, we need profitable businesses in order to pay for the transition. But there is, of course, more. It must be done in such a way that society is not harmed, because the objective, the purpose of what we all do, is making this a happier, healthier planet for all in full inclusion. That is why we do this. Unfortunately, although we are here in Europe, we do not live on an island. Some people, and in some countries, there are those that have different ideas. And I would like to discuss some of these ideas with you now. I just came from a 2-week roadshow through the United States of America. And I want to introduce you to a concept called, and you can find it on their website, freedom to invest, freedomtoinvest.com. And what is this initiative by investors about? So last week we were in Boston at Ceres, basically the organization that founded GRI. GRI is originally a US organization, founded in 1997. So what does this freedom of invest all about? Currently, in the United States, in some states, legislation has been introduced that tries to achieve exactly the opposite that currently is being implemented in Europe thanks to the great activities of our friends of FREC. That is, reporting on double materiality sustainability. So we see in some states, Florida, Texas, Ohio, Missouri, etc., 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 legislation that basically prohibits investments into organizations and funds that are dealing with ESG or sustainability topics. Can you imagine? That is restricting your freedom to invest as bank, financial institution, pension funds, sovereign wealth funds, etc., etc., etc. So I got this question from a journalist from Bloomberg, what my ideas were about this, and then being in the US and being sucked into this poisonous political debate, and looking also at my background, how can I answer in a polite way without trying to be too offensive and try to just bring across the logic of why we do it, not only out of altruism and doing good, but also the business logic behind it. And it's not that difficult. My career, I used to be a head of tax, treasury, risk management, and CFO before taking on this job. And what I learned as risk manager is that it's not about achieving to obtain the lowest insurance premiums you have to pay, but that it's about mitigating risks. Mitigating risks. And the legislation we see currently in some of the US states is basically about pushing boardrooms, about forsaking their fiduciary duty towards their investors and society. What do I mean with that? Let me give you 3 examples. You're in retail, we have global warming, so you need more cooling equipment to keep your products fresh. If you do not take global warming into account and climate change into account in your energy procurement policy, then you will face a big issue with your investors, because as we said, with the invasions in Russia, as the first speaker said, we face an energy crisis that must be mitigated. Secondly, if you're a platform organization, and now we go to another one, and you do not take workplace safety, diversity, the right to organize, equal pay into account, you will be faced and you will be confronted with a workforce that will be pretty, I can't find another word, pissed off with you, and start to organize strikes and in the disruptive mode that will absolutely hit your bottom line. And if you're in construction, and if you do not have your anti-bribery policy in order and monitor and control whether or not this policy is properly executed, as happened quite recently with a Dutch multinational company, and you obtained the railroad contract in Saudi Arabia by bribing yourself into the deal, and it comes into the open, you face criminal litigations, you will not receive any contracts in any other countries anymore, you lose your license to operate. So what is this all about? The first example of the retailer is the E. The second example of the platform organization that we have seen in many countries basically effectively happening, also in Europe, is about the S. And the third one, the last one, anti-bribery, that is about the G, E, S, and G. So how can certain states in the United States come up with legislation that try to discourage boardrooms and management to mitigate these risks? Because not taking care of these risks as a boardroom is malpractice and a financial offense by itself. I, as investor, would never lay in $1 or €1 in an organization that on purpose is not mitigating these risks. And I think we should be very careful that we find the right tone in discussions with whatever administration will come up in the United States, that we are and keep our freedom to invest, and that we enable boardrooms to fulfill their fiduciary duty, not only on behalf of investors, but also on behalf of our planet and our people. Thank you very much.
Thank you very much. I think that was a real tour de force about the US, which is the world's largest economy and still has major influence on everything that happens globally. So now I would like to introduce Mr. Martin Špolc from the European Commission, and it will be followed by our very first panel, which will be moderated by Nadia Humphreys from Bloomberg. And we are very, very lucky to have actually quite a lot of the new EU Sustainable Platform members today with us. So I think this is going to be a super interesting discussion between the platform members and between also practitioners, both from government, with Katarzyna Schwarz joining us from Poland, and with another practitioner here from the local market, Mr. Lubomir Vyshtavel from Goldman Sachs Asset Management. So thank you very much, and I'll give the word now to Martin and then to Nadia and everybody else. Thank you.
Trust.
Brilliant, thank you. Does this work all right? Perfect. Thank you all so much. Really excited to start to pivot away from maybe some US context and across to some European context. And if I will, by way of introduction, maybe open the floor for Martin to share a few words in terms of the EU Sustainable Finance Agenda, what's happening currently, maybe some view on what's happening in the kind of future line of sight. If you wouldn't mind, Martin, just sharing a couple of your thoughts with us.
Thank you very much, Nadia. Good morning to you all. First of all, compliments to Linda for having organized such a great event. I have to say that I have attended several events on sustainable finance in the region, but this is really one of the very best events, and I hope that this will stay like that. I must say that 5 years ago, when we started to draft the first action plan on sustainable finance, it was in 2018, I never dreamed that in my own town there would be an event, a big event for 5 days on sustainable finance. So I see that now, Linda, you don't have to be lonely. I think that you are surrounded by a number of great people. Today I have not come to preach the members of the platform, or those of you who I know. I have come here to try to help the debate, because opening the conversation on this policy is very important and very difficult in this region. So I will try in my speech, short speech and then discussion, to articulate the opportunities that this agenda offers. This is not only about regulatory burdens. Obviously, this agenda does cause burdens, but it is in the first place about opportunities. I discussed with Martin L. before the start of the event that we always need to make an effort to translate why we are doing things, not only from the EU mantra perspective, but what it is good for you, what it is good for the financial sector and the businesses, and I hope that the debate will go in that direction. Now, 5 years ago, we have established 2 overarching objectives for our policy. First, to reorient capital flows towards sustainable investment. We have a huge investment gap and public money will never be sufficient. And second, we wanted to make sure that the financial sector itself, but now also corporates, have to be resilient to withstand the risks that we are observing from climate change and environmental degradation. Now, translating this EU mantra into your ears, what does it mean for you? Well, for the financial sector, in the first place, a new set of great opportunities for financing. And not only for financing what is green today, but what is becoming greener and ultimately will become green. And this is a massive space that the financing and financial sector can occupy. And I think that those of you who are working in the financial sector and would like to continue in a sustainable way, you do need to notice this. Second, for those who are not in the financial sector but who are in the corporate business, if you want to attract capital for, again, becoming sustainable, and not necessarily only tomorrow, but for becoming better and for improving your environmental performance, being interested in this agenda is absolutely essential. So you will need to understand the key concepts, how the financial sector operates and uses, and how the conversation between the financial sector and businesses goes on. Now, it's very simple. Our agenda has been based on 3 main pillars. The first pillar was to create clarity which economic projects, which economic activities are ultimately aligned with our targets, with our European Green Deal targets, climate objectives, and environmental objectives. And this is why we started to work on taxonomy. I mean, this is a kind of techno word, but it essentially means a classification system that brings clarity what is ultimately good enough to be aligned with the environmental objectives. This is a project that we have not started on our own. This is a project that the financial sector asked us to develop, and this is what we have done. So 5 years later, we have developed the climate taxonomy. The second pillar of our policy is transparency and disclosures. And yes, indeed, we do need better transparency. We do need to understand better the environmental performance of the companies so that the financial sector can understand where to invest and how. And this is where we have regulated to impose requirements not only on the financial sector, but also on the corporates. This is the second pillar. And the third pillar, it's very basic. It's about tools and instruments. And tools and instruments that are voluntary, that are not obligatory, but we are putting at disposal to the community of the corporates and the financial sector. Those of them who would like to make an impact, they are free to use them. So here we are talking about climate benchmarks, the European Green Bond Standards, etc., etc. Now, where are we? On taxonomy, I mentioned that we have already developed the first set of climate taxonomy, which is a set of activities that substantially contribute to climate change mitigation and climate change adaptation. And it's quite an impressive coverage of this climate taxonomy. It covers 2/3 of emissions. So we are certainly not talking about the green niche. We are talking about key economic sectors, such as building, transport, energy, where the potential to reduce carbon emissions is very significant. Now we are finalizing the taxonomy also for the other 4 environmental objectives. We have circular economy, we have prevention and control of pollution, we have water protection and marine resources, and biodiversity. And the Commission, in 4 weeks' time, will adopt the new taxonomy on these other 4 environmental objectives. So those of you who are interested, please watch that space, because it will only expand the usage of taxonomy. When it comes to the second pillar and the reporting standards, we have, as I mentioned, already regulated the financial sector transparency, but now we are moving to the next stage, which is bringing clarity into the standards that the corporates that are subject to so-called Corporate Sustainability Reporting Directive, that they have to report. Now, we have tried to reduce the burdens of these standards to the extent possible, and in coming weeks, approximately 3-4 weeks, the Commission will launch a consultation on the set of standards based on the work that EFRAG has done. We have done this work, again, in the first place to bring transparency and improve the conversation between the financial sector and the corporates. But we have done a lot of work that is supposed to be enabling stakeholders to use this framework. So the disclosures and the regulatory requirements are a very important part of the framework, but this is certainly not enough. We do encourage stakeholders, and especially the financial sector and corporates, to have a conversation on how the transition towards meeting these objectives will evolve. And this is something that cannot be achieved only through regulation and legislation. So here we are now, I mean, if you ask me what are the current priorities in the Commission, we are looking not only on how to finance green, on what is already green today or what will become green tomorrow, but how to become greener and how to improve the environmental performance or social performance indicators over time. So this term transition finance has been really brought to the attention of many. And those of you who are interested, the Commission will provide a piece that will hopefully be a useful guide to everyone how the existing framework can help this transition finance. And the second big priority that is currently very high on our agenda is the so-called usability or simplification, or I would translate it in simple words, make it work on the ground. The success of this agenda will depend on how, first, stakeholders can comply with the regulatory requirements, but what they can take from the tools and instruments that we have put forward and how they will make impact with them. And we have detected that there are some bugs in the system, either in the framework that we are operating, also in the way how the stakeholders are operating. And we call it usability aspects. So we are trying to clean the homework as much as possible. I mean, stakeholders are raising concerns and challenges with the reporting requirements and with complying with some of the new rules, and it's legitimate that they are raising these concerns. And the Commission is now really paying its utmost attention to address them. So this usability work has really attracted a lot of attention on our side. We have also articulated where the different pieces of our regulatory puzzle can interact better, and we will disclose a piece on this in mid-June. My final point is that it was mentioned that there are some problems with ESG ratings. Yes, we have seen that there are indeed some problems with ESG ratings, especially transparency. There will be a dedicated panel on that. The European Commission decided to put forward a legislative proposal. This will be the last legislative proposal on sustainable finance under the mandate of this European Commission, and we will do that in 4 weeks' time. On the 13th of June, the Commission will adopt a proposal that will not harmonize how ESG ratings should be assigned, but it will introduce a minimum degree of transparency and clarity that ESG rating providers have to comply with. I think that now I have really come to the end. I promised you that I will try to convince you why you should watch this space and why you should be encouraged to follow this discussion, especially on transition finance. I have to say that there is nowhere there's nowhere in the European Union where the transition finance, I think, can be so relevant than in the CEE region. And the purpose of this agenda is to shift the narrative from those of you who are green, you are great, and if you are not, then shame on you, into a narrative that everyone can improve. Everyone can improve. And the purpose of this agenda is to put forward a set of tools and instruments that would allow everyone, irrespective of the starting point, irrespective of the economic sector, to make an improvement. And this is exactly where the conversation between the financial sector, corporates, and other stakeholders matters so much. So I look forward to the discussion. Thank you.
Brilliant. Thank you, Martin. A huge amount of food for thought in that opener. Thank you. Before I kind of steal a few questions myself on topics that Martin has brought up with our other panelists, I do want to draw your attention to the fact that we will have some open Q&A. So Slido is open. The hashtag, you can almost see at the bottom, is hashtag CEE Summit 2023, behind Katarzyna's head there. There we go. So please do log on and ask questions. I will do my very best at the end to try and bridge some of the important topics that I know Martin had raised. Katarzyna, if I can turn to you actually first. So Martin talked about 3 key objectives. So one was reorienting capital to sustainable outcomes. The other is looking at transparency, and the third is risk management. And I'm just curious for your role and what you observe in Poland specifically. How is that turning from kind of an ambition into practice? Could you share a little bit of that with us?
Well, absolutely. Thank you for that question. But first of all, before I jump into answering it, thank you very much to the entire ISFC team for having me here and for making this wonderful event happen. I'm really happy to be here. I'm actually quite convinced. People always ask, what's the next big thing in sustainable finance? Is it transparency? Is it ratings? I'm actually quite convinced it's CEE. So, and this is the approach we're taking in Poland. For us, sustainable finance is not a compliance exercise. We obviously have enormous financing needs to make our climate transition happen. At the Ministry of Finance, together with our advisors, we calculated that by 2050, it's gonna take around 2 trillion euros to finance a transition just in the 4 key sectors. This amounts to almost 9% of GDP. Of course, the incremental investment is between 1% and 2%, which is close to what other OECD countries will have to invest, but it is still an enormous amount of investment, and the public investor will not be able to take the bill by itself. That is why year, we launched work on a roadmap for the development of sustainable finance in Poland. The idea is to coordinate, bring together all the wonderful things that are already happening in the Polish market, and ensure that in 5 years, we as a country, as the largest capital market in the CEE indeed, are able to offer efficient financial instruments, mechanisms to translate our savings and capital into investment into sustainability transition, that we have a vibrant ecosystem of services that is capable of supporting that. I'm talking sustainability audit, I'm talking green bond certification, I'm talking professional advice that, for example, can work together with high-emitting companies that still form a large part of our economy, to take them through that transition, to explain to them that actually they are the addressee, the object of that entire exercise, as it is a no-brainer to put more money into something that is already green. It is no-brainer to invest more into Apple's or Alphabet's debt, and then be happy about the great credentials about the portfolio, right? But the trick is to invest in those companies that are very high emitting today and have credible transition strategies with very clear and transparent key milestones. That is the objective number one. The objective number two is we take our responsibility as the biggest capital market in this part of Europe very seriously. We want to ensure that whatever we do as part of our roadmap and as part of our plan in the next couple of years can also serve the entire region. That our stock exchange is open to listings of equity, of sustainable debt, that we have indices and ratings that can help attract capital from the region, but also from global investors. We want to ensure that local governments or smaller corporates will no longer have to call London or Amsterdam to get their sustainable bonds rating, but they will be able to call someone in our region and deal with it locally. We are supported by the Polish Sustainable Finance Platform, which brings together capital market practitioners, representatives of the entire capital market community, as well as NGOs such as the UN Global Compact Network, and of course other ministries and the regulator. For we truly believe that only the cooperation between all those actors will help us achieve that goal. Nonetheless, having said that, and just to briefly relate to Martin's wonderful presentation, I think in a way we are very lucky to be in the EU at this time, as much as we complain sometimes about this tsunami of regulations that is flowing from Brussels towards us. It actually helps with transparency. It helps with bringing all the standards to one common denominator. So when you talk to people, they really see that as an advantage at the end.
Thank you, Katarzyna. That's a lot. So I heard a couple of things from you. One I will pick up on a little later, which is transition, and maybe come to Martin on that point too. But before I do, Agnieszka, so Katarzyna mentioned the word tsunami of regulation. And I just wanted to kind of maybe dig a little into kind of on the floor. What is it like? What are you observing? So Martin mentioned it's taken the Commission and their technical working groups kind of 5 years to get to some degree of maturity of the taxonomy, although I would argue we're as yet still got more and more to continue to do. That is a brand new reporting requirement on a lot of European companies. And I was just curious, what have you observed at the moment in terms of the take-up and use of these tools?
Thank you, Nadia. Thank you for the question. So you can clearly see my throat is dry because Nadia is making me to reply to Martin in front of all the people, and I just joined the platform, so I'm going to complain as the first one. That's not fair. What doesn't work from the perspective of companies. So maybe I will start from thank you to International Sustainable Finance Center and to Linda Zeilina for invitation and having this possibility to discuss in front of others what things could be improved. But I have followed the recommendation from Martin, and I've been participating or listening to debates what companies see as a first priority. And clearly, as Nadia said, this is reporting, which is a little bit a surprise, but I think this is the approach that they want to be ready, and this is the biggest challenge they see, to be ready with reporting on sustainable finance regulations. And for me, it's a little bit a sequence problem, yeah? So I strongly believe that given the level of detail in SFDR, but also non-financial regulations, it calls for implementing ESG processes to companies' operations. Without this integration of ESG processes, reporting will be very high level. Yeah? So the reporting is a moment to see whether we have it. Yes, otherwise we don't have anything to report as companies. But also it is a checkpoint to see whether entities are purpose-driven, as it was said before, and whether those ambitious are within a strategy. Yeah? So the sequence should be from strategy to processes and then to reporting. The question is whether the companies used time in a good way. Also, another risk potential is that companies might interpret regulations lower than expected due to problems with accuracy and consistent of data for different matrix. This is still a challenge. Yeah? So I think this, as you say, regulatory overload pushes us to things that might not be a right way to prioritizing by companies, but also seeing this problem with interpretation. And maybe one more thing to strongly emphasize, that the data is available. The issue is that we still there are swaths of data which issuers need to add to the current disclosure. And this is not just about small companies, SMEs. Still, public large companies don't disclose what we need as financial institutions. So this, again, this sequence of reporting and across the regulatory framework is also a bit of a challenge for companies. And maybe, as we discussed it before, if you don't do right sequence, then you don't see how many operational resources companies need and financial power to fuel these efforts. Yeah? We still see very small, in many companies, too small teams that covers those issues. So I think other than regulatory overload, interpretation problem, maybe sometimes misalignment between many regulations that are part of sustainable finance framework. That is something to help, and I know European Commission is addressing, but still, yeah, the time passed and we said we don't have so much time.
Brilliant, I guess. I see Martin diligently taking notes, so he's obviously going to be the next one I turn to here. It's true that the taxonomy is a very new way of reporting, and people need to adjust to that. And in the eye of something that could be perceived to be quite complex and very new, is there the risk that this becomes what you don't want, the compliance tick box exercise. And so Martin, maybe to address some of Agnieszka's points around usability, is the Commission aware? And if so, what are you doing about them?
Is certainly aware, and we have received a number of claims from stakeholders that either the criteria that we have put in the taxonomy are not entirely clear, and we have already provided some clarifications for the most important cases, but also when the stakeholders are supposed to now report against taxonomy. I mentioned that the only requirement from the regulatory point of view is disclosure. Corporates have to disclose the proportion of their taxonomy-aligned revenues and taxonomy-aligned capital expenditures and operational expenditures, and the financial sector participants have to disclose to what extent their financial products that they are selling are aligned with taxonomy. And there are many practical issues that arise, and we have already provided a number of clarifications, but this process is ongoing. I mean, we have to respond to the requests, you know, on an ongoing basis. So there are issues. Agnieszka, you mentioned also the sequencing. I have to admit that the fact that we have started first with the regulation and transparency of the financial sector, and only now follow up with the transparency by the corporates is not optimal, because the financial sector has to obviously report against the data that they will gather from corporates. They have some information on their own, like banks are getting from their clients, but it is not optimal. So we have tried to address these kind of first introductory difficulties and challenges through, again, guidances. Now, you also mentioned that there are some misalignments of the different pieces. I will not name all the regulatory pieces that we have put in place, but there are some misalignments. And now we have clarified that as long as you are complying with one of the pieces, then it means that you can also comply with another one. So we are, again, providing some concepts of safe harbors, etc. It's very technical, but we are doing it. On the usability, our previous group that we had, a group of experts, I must say, and many of you actually some of you in this room are on the group or were on the group, have helped us to identify the key challenges that stakeholders are facing, especially when it comes to taxonomy and also the overall framework. Now we have a new group. Agnieszka and Nadia and Shona are there on the group, and Linda, by the way, as well. And the main purpose of this group, the main task of this group is to not only identify the challenges, but also identify the solutions. So it's an evolving process. And the only thing that I can say today is that the Commission really listens a lot. We take it very seriously. And you know, the mantra that I have presented to you, make it work on the ground, is really now a very serious agenda.
Brilliant, thank you, Martin. So maybe, if I may, Agnieszka, to come back to you. So Martin mentioned this thing called the platform, newly appointed. Could you just explain kind of what the remit and the structure of the platform is for people?
Thank you very much for this question. Yeah, I feel very privileged to be part of the platform, and in the new mandate, so the platform 2.0 operates in a structure that has 35 members and 14 observers, and we discuss through plenary. But what is very important is that most of the technical work, recommendations, report, opinions are prepared within subgroups that are dedicated to major tasks. And right now we have 3 major subgroups, 3 major tasks. Martin mentioned one of them, which is usability. This new platform operates under very different contexts. So we are seeing markets, companies have started to apply taxonomy. So we will have more data on how useful is this tool, and whether there are some rooms to how is it implemented, and whether there are some ways to improve usability of this tool, as well as the whole framework for sustainable finance as a wider set of instruments and tools. The first task, when we think about usability, will also look at data availability, data quality. As I said, large companies will have a challenge, but they should meet the challenge. for the smaller companies, there is a need to find some fixed consolidated system to collect the data. There is also a second subgroup that will look at taxonomy criteria, how they are being implemented, whether there are some misinterpretation or there's not enough clarity, so maybe there is a need for potential revision. And the last subgroup, which will look at the flow of capital and will monitor the flow of capital into sustainable finance. So that would be 3 streams that European Commission is looking at platform on advising on those 3 major points.
Brilliant, thank you very much. A big remit on a slightly smaller platform this time around. So, and maybe if I can, to Lubomir, to turn to you, because really what we're trying to do here is offer a framework that points to what does good look like. So until the existence, I would argue, of the EU agenda, being sustainable meant that I am, relative to my peer group, slightly outperforming them on a set of E, S, or G metrics. And that wasn't good enough to hit net zero. So the taxonomy has come in, and the taxonomy is now pointing to what, for certain sectors, is environmental sustainability. What does that look like, and how do I need to perform, and companies need to report under that. One of the things that I found really interesting when I was doing my prep work for this panel is actually a few signals. So Martin talks about a framework that importantly is looking at demand. So it believes that demand exists for sustainable outcomes in order for the entire framework to be successful. And I just wanted to maybe share with you a few data points that Goldman's research I recently read had in it that I think kind of ticks the box that Martin was talking about, to be fair. So we have, for those unfamiliar, products called Article 8 products, and they pursue environmental or social characteristics. And we have those Article 9 products that pursue, that have objectives that are environmentally or socially focused at their heart. What we've observed through some of the research from Goldman Sachs is that these Article 9 products that have taxonomy-aligned investee companies, the taxonomy alignment of those companies is about 450% overweight relative to the benchmark. And for the Article 8, it's about 100% overweight. That means that even within these sustainable products, investors are demanding taxonomy alignment. They see the reward from that. And I'm just interested, Lubomir, in terms of your approach to investment and sustainable investment, how different has this reg agenda made your day-to-day?
Thank you. Thank you very much. Thank you for to the organizers for having me on this panel. It's an honor to be here. It's the right question in a way on how the region is contributing to this, or how we a little bit on the backyard of Europe, how we are evolving in this sense. And initially, the approach was quite cynical, or the responses from the general public were quite cynical about true belief in ESG and sustainable investing as such. However, that discussion, I think, is changing enormously. I think that it's becoming not a question of why to do that, but how, and how to participate and how to contribute. From the clients that we, the AUM that we manage, we have quite a considerable amount of time dedicated now to questions around sustainability, about how we screen for ESG, how we make sure that the parameters are met, or how we do our work, and on what sources of data we use, whether we look for third-party providers for the data, or whether we look for internal research. And yeah, it's a lot of discussion about how these things are combined. And I think it's clear that the wave of interest in sustainable investing and in making the change and participating on that, either for the objective of avoiding the risks or for the objective of actually participating and getting extra returns for doing the right thing at the same time is the objective.
Yeah, that's really interesting. One other metric I observed is that, and this is as of Q1 this year, the Article 9 ETF products, 70% of them saw inflows. And they're quite sticky in that only 19% saw any degree of outflow. And when you compare that, for example, to Article 8, we saw that 53% were drawing inflows, but 32% were drawing outflows. So is this your observation? When you have conversations with clients, are they quite particular about wanting, you know, the true Article 9, the environmental or social objective of their investment? Is that something you are seeing?
We are indeed observing that there is a lot, the flows into financial products or investment funds on the market are indeed discriminating a lot between those that are just not integrating ESG factors at all, which are actually on active asset management, seeing some outflows given the environment. But we see inflows relatively steady into Article 8 or Article 9 products, even in markets which in general would see outflows. So we see that it is stable. And yes, we see, let's say, more interest in Article 9 defined products. But Article 8 is also depending on the particular niche or need of the investor. Is also making the trick, if I can call it that way. It's also meeting the hurdle of actually going in the right direction, because I think we do all realize that the world is not made of only sustainable investments. And if we have all started to take our money out from those that we do not define sustainable, no matter how we look at that, then a lot of projects that are, a lot of companies that are needed to actually fulfill our current needs that we have, that will not be financed, that will not be possible. So there is a clear need not to make it just a transition like a flip of our fingers. It's not going to happen like that. We all, in this room, I'm sure, should realize that this is a transition, and so I call it a transition as well. It's something that is going to happen over time. And I think that's really important to facilitate that the transition and to be part of that. Clearly, there are investors that would focus to be there already now, and that's the right thing to do. Why not? But there are also others that are understanding that there are bigger impact might be also with products that actually are looking at not only at those companies that are already meeting the criteria, but companies that have the potential and have committed to make the transition. And there is a big role for the financial industry in an active engagement, be it banks on the financing or asset managers in talking to the companies, and through that engagement really enable the change.
And I think, oh look, Martin's always cueing me with his little notes there, so I'm definitely going to jump to you next. And I think, look, there is, in my opinion, a misunderstood criticism of the taxonomy that it only rewards companies that are like the deepest green. And therefore, what we're seeing is this big demand for these Article 9 products. Can they therefore, as I said, 450% overweight to taxonomy-aligned investments? My understanding of that is lots of people are quoting kind of revenue or turnover figures at me. And actually, capital expenditure is a really interesting tool in the taxonomy. I wondered if you might be able to touch on that point, but also just more generally in the transition. Is it okay for an Article 9 product to have transitioning investee companies, for example?
Thank you, Nadia. First of all, we have clarified that Article 9 products do not have to have only taxonomy-aligned investments recently, which I hope, reassured markets. So we have provided flexibility to the markets. Now, taxonomy is still a very central piece of our agenda. And those who argue that taxonomy is very tight and is very ambitious, they are right. But does it mean that it can be used only by a small niche of the markets, that's very wrong. And I will give you 2 examples how you can use taxonomy even if you do not necessarily meet the environmental performance criteria today. The first one is if you are currently operating a company that doesn't generate a single crown or euro from the revenues that would be of taxonomy stemming from taxonomy aligned activities, you can still have a capital expenditure, an investment that over the next 5 to 10 years will ultimately allow you to reach the environmental performance that you need, and you can still claim it as capital expenditure taxonomy aligned, which I think is a very big opportunity for anyone. And again, I would like to highlight, especially in this region, in the CEE region, basically any company that doesn't generate a single euro or crown in terms of revenues can invest in projects, and then the compliance with the criteria, especially do not significant harm, can be achieved only at the end of this period. This is a massive opportunity. So, you know, again, if I give you an example, a cement company that is producing cement can invest in a new technology, can issue even a green bond that would be then taxonomy aligned, and then this investment can be deemed as taxonomy for the reporting purposes. The second opportunity how you can use taxonomy, even if you don't meet the criteria today, you can have a transition plan. And again, we are not forcing anyone now, I mean, everyone to have a transition plan, but those companies who would like to communicate to their financial community how they are going to transition, they can disclose how they intend to improve their environmental performance over time. So to give you an example, this cement company can say today, I have no taxonomy aligned revenues or no taxonomy aligned CapEx or OpEx, but in 5 years' time, it will increase to 5%, which is already an important information. Or another example, today I am not meeting the non-significant harm criteria, i.e. I am causing significant harm to the environment, but in 5 years' time or 10 years' time, I will cease, I will stop causing significant harm, and I will get out of the red zone, which is currently defined by the taxonomy. So again, the taxonomy is not penalizing anyone. It should be in the first place as a tool, as a useful tool. And again, the Commission is currently working on providing useful practical tips. And let me emphasize useful practical tips that are voluntary, that ultimately stakeholders can grab if they see the opportunity. There will be no further regulation that will tell people you have to invest in these assets, you have to divest from those assets, you have to engage in these companies, you have to engage in these activities. That would be a Sovietic planning, and you know, I'm speaking in Prague, being Czech. So I hope that this clarifies.
Brilliant, thank you, Martin. And I think this is probably one of the most important messages on this panel. And Lubomir, if I may just very quickly turn to you, because in Goldman's sustainability report, you talk a little around an NL bond that was launched that's sustainably linked, that looks at future taxonomy-based outcomes. So to Martin's point, the taxonomy is a tool, but there's still a range of creativity that an investor can have with that tool. And I wondered if you could just maybe touch very lightly on kind of the practical aspects of the tools that are now available to you.
Well, I haven't participated on this issuance, but I do know that there's a lot of innovation within our firm, but also in market in general, around sustainable instruments and financing. And I think it is exactly what we actually need at this moment, is to look at this as a tremendous opportunity to really mobilize the resources, be it financial or human or other capital resources that we have available to enable that change, and to see or help our clients see and help them how to achieve the transformation, how to work on that transition. So it's exactly our role, how we are fitting into bridging and cooperating with our clients on finding the solutions. Goldman Sachs is committed to $750 billion of sustainable investing over 10 years, 3 years ago. I think in this report that you mentioned, it's already mentioned there that 3 years on the road we have already reached 55% of that target. So it seems like there is a lot of acceleration in this mode, and this target will probably be exceeded. So it fulfills me with personal hope that the resources and the energy is put in the right context, and this innovation will help investors, will help the companies to find the resources that are needed to enable this.
Thank you. And maybe I'm going to open up to Slido in just a couple of minutes if you do have any questions you want to add. But Katarzyna, if I can come to you with my last question at the moment. A lot of what we've talked about on the panel, I think, hinges on education and the importance of people knowing and understanding the tools available to them, how to execute them, to Agnieszka's point on actual corporate reporting, but then from an investment perspective. I wondered if maybe we could touch a little on the important role of education as you see it as well.
Well, absolutely, you know, and sometimes when people mention education, they consider it something secondary, something that will only bring results in the long term, so maybe something we shouldn't be focusing on that much at the moment. And it was such a positive surprise to me. You know, a couple of weeks ago, we organized this Polish Capital Market Development Days in London. We had an opportunity, thanks to the European Bank of Reconstruction and Development, to discuss with largest asset managers and investment banks, global investment banks, what's the idea to create, to make Poland this regional sustainable finance hub. And the first question, after the data question, was, okay, so what are you doing about education? What are you doing about skills? What we see is a huge skills gap, and it has a very practical dimension. It's not only about creating this awareness amongst the public, but it's also about global financial institutions having experts on the ground being able to select genuinely sustainable projects, credibly sell in green or sustainable financial instruments and explain what they are about, and report about any potential greenwashing instances. So we absolutely need to get this right. That is why the most recent decision of the Polish Sustainable Finance Platform was to launch an education and skills working group, which will focus on measuring the market, so seeing what's available, what is the gap in terms of equipping people with skills to be able to serve financial institutions, to serve as chief sustainability officers at corporates, to be able to provide this very professional advice and service. We're going to look at what are the standards amongst these available trainings and postgraduate studies, because we know that whilst some of them are really top-notch and really good, some of them not necessarily stick to those standards, simply because there is so high demand and not enough professional supplies. So we're working with universities, but also with the corporate sectors to get that right. So this is, I think this education is an absolutely fundamental thing within the sort of sustainable finance development roadmap, and it's not something that will become important in 5, 10, 50 years' time. It's important now.
Very, very true. Thank you. And good message. I'm going to open up to Slido. Apologies, Martin. There's a lot in here on.
I will make another note.
Yeah. Are you ready? I'm going to start with one thread that is coming through. So a lot of what we focused on, specifically with the taxonomy, is about environmental sustainability. But obviously, these SFDR products consider both the environment and the social aspects. So what tools, if any, are available to measure social performance? Are there any plans within the Commission to develop social tools?
Look, when it comes to the tools and instruments, there were two that the Commission developed. The first one is climate benchmarks, and I see Elena, who was the author of the architecture of the work, which is focusing on climate. And then we have the European Green Bond Standard, which is focusing on the environmental, on the letter E. The Commission has not produced, and again, we have not harmonized the the benchmark, so we have not harmonized the European Green Bond Standard. We have introduced minimum degree of requirements that have to be met. So again, this is not a full harmonization, this is a kind of framework within which the instruments can be sold. Now, when it comes to letter S, the Commission has not produced any piece of legislation or that would introduce a tool or instrument on S. We are currently working on exploring options, I would put it carefully, whether we would need to do something on the ESG benchmarks. We have carried out a study that has come to the conclusion that there is a space to do something, but the Commission has not yet decided on what we will do about the ESG benchmarks. But here I would like to make one important point, and I hope that Lubomir will like it, is that we don't believe that we necessarily have to regulate everything. Mm-hmm. I just mentioned that this agenda is supposed to be an enabling agenda. Indeed, there is a very important part which is regulation that provides the transparency, integrity, and clarity, which is taxonomy. But then there is a space that the financial sector should occupy, and I would say even a bigger space. They should play with the tools and the transparency that we are putting forward. But we are not telling you how fast or what exactly. This is now in your remit. And I personally do not believe that we have to regulate every single standard or every single label, like the sustainability linked bonds by NL that was mentioned, or that we would have to regulate and harmonize everything that moves. This is a playing field for the sector. The financial sector is very well known, for good innovative engineering. And we do not want to kill innovation. So here, you have a lot of space to make impact. And what we are going to focus now in the next 1.5 years until the end of the mandate of this commission is first the usability that I mentioned, transition finance, and bringing impact. I do believe that we need to start talking about how we switch the conversation from why and what into now how fast, and bringing the impact on the market. But that's in the hands of the financial sector and the corporates. Have a conversation how this transition will evolve, and that will not be coming from my office.
Thank you, Martin. Another question, if I may, to you. So you'd mentioned that your only or your final piece of legislation for this commission is going to be ESG ratings and scores. There's a question in here in terms of some supplementary Q&As and guidance for the market on taxonomy and SFDR. Is there still that within the plans for the commission?
Yes, in 4 weeks' time, and I was just working until 1:30 precisely to finalize a document that we will publish in mid-June that will bring clarity into the questions that stakeholders have asked about not only taxonomy and the SFDR, but also the interactions of these pieces. And I mentioned the concepts of safe harbors, also the use of estimates and how these pieces can interact in harmony at the end of the day. Just to give you an example, if you have a climate benchmark that is recognized by the EU law, then you are automatically recognized under the SFDR, under the concept of sustainable investment. Or if you have, and this is something that is still being prepared, if you have taxonomy-aligned investments, then there is accordingly appropriate treatment under the SFDR, so that there is not a double burden imposed on the industry, because there is some misalignments of the definition and concepts that, again, unfortunately arose due to the negotiations.
Brilliant, thank you, Martin. One question, I'm going to open this to the whole panel, so let me know which one of you want to take it. So for SFDR in particular, and I think this maybe touches on the point Martin raised, so half the market are saying, tell me exactly what I need to do, Martin, prescriptively, and I will do exactly what you tell me to. And the other half is, give us a bit of breathing room and some creativity and some space to operate. This question, I think, is coming from the place of, I'd like to know exactly what to do. So given that SFDR is a tool for disclosure, predominantly to the retail market, and maybe Lubomir, I'll open with you, is there the concern that those receiving that disclosure understand what they're receiving? Its complexity and content, is that being well received? And I know you deal mainly with institutional investors, but do they understand the content you are now disclosing to them?
Yeah, well, I think that the taxonomy as such, or any creation of a vocabulary that is kind of defined and helps people understand what is being spoken, a kind of dictionary in explanatory form, is good in a sense that it helps people to understand what is the common ground. However, and that's my personal belief, is that there needs to be a space for interpretation. There needs to be a space for a judgment. These are not hard-coded things. I mean, it was rightly mentioned on the E, everything can be easily measured, perhaps. Not everything, but a lot of these things can be easily measured and can be put on tables. On S and G, there's lots of efforts to try to translate these inputs into numerical forms and try to work with them to create the ESG ratings that have been mentioned here. And the transparency around how those ratings are designed, I think it is something that investors are rightly questioning or asking, what does it mean? And if from one provider we have a rating of this, and from another provider there is a different rating, how do they compare? So there is something that we will need to get used to in working with these inputs. But any financial analyst, any credit officer is creating a vision in analyzing a company and a project on his own belief in how he believes the company is presenting to him. The analyst needs to create his own plan for the company or his visualization of how the company is going to create business plan. It needs to, the analyst needs to figure out whether he believes or doesn't believe what the company is presenting to him. So I think that work on the analyst side to actually dig into the data and work with it will not be eliminated. And I think it's something that will be needed, and I think that is good. It's good because I think we should not be striving for the world where we are all thinking alike, that we have all the same. That's what is making us the diversity that we are trying to reach. It should be diversity of the opinions. Also, there will be competing business plans. So if this company is wanting to achieve this, how come the other company is trying to achieve the same and they are competing against each other? So I think the space for the interpretation will need to be preserved.
Yeah, thank you. I don't know if moderators are allowed to voice their opinion, but I certainly agree with you in terms of the freedom. That anecdote I always give is going into a health food store and choosing cereal bars. And you and I may have very different opinions about what health is. I might want organic ingredients. You might want keto, low carb, who knows? But the product range is available to us for our own individual definition of health. And I think that freedom's really important. Katarzyna, I might just ask a question to you, actually. So we've talked a lot about the taxonomy as it's applicable to the private sector. Public sector use of the taxonomy, is that something that's being considered? I know it's not mandated, but...
Well, it's certainly ahead of us. Mm-hmm. It's certainly ahead of us, not at the moment not being considered by public sectors in Europe, but I think we will absolutely need to get there. I mean, public sector needs to be needs to serve as the good example, not merely a follower.
Perfect, thank you. I'm very conscious of time, and apologies, people. There's a lot of lovely questions here, but maybe if I will, I might jump to some concluding statements. And the concluding statement I'm really interested in the group making is, our title is, Can Europe Lead on Sustainable Finance, and Will Its Policies Deliver? And Agnieszka, I'm gonna start with you and then maybe move round to Martin. We might know what we think his answer will be there. Agnieszka, if I could ask you that.
I strongly believe that it will deliver, although there is a room for many voluntary actions as well, as Martin said. Not everything has to be regulated, and there is room for interpretation. But I guess the big question is how the play is being structured. What are the rules for what comes first, what comes second? So I especially like the question about the disclosure for retail investors, right? The thing is that sometimes we think that this is my personal view, but then we would like someone else to take responsibility for that, and that's what happened with financial sector before, right? investors, retail investors want something, but then they are afraid what they want, and after some time they come back and said, we were not aware that this is what we want, yeah? So this is something to put to the discussion more, so we will not end up in the places that we have been before, right? So this is what we are taking responsibility, but as a financial institutions, but where the line is it a hard line, or, yeah? So this is, I think this is up to for another panel to discuss. Thank you.
Katarzyna, will Europe deliver?
Well, I kind of think we already are, aren't we? We are already a leader in sustainable finance in so many dimensions, in the volumes of sustainable instruments being issued, on the complexity but also comprehensibility of the regulatory framework around it. So I think we're certainly on a good path. Obviously, there are certain challenges here mentioned by both Agnieszka and Lubomir, like the complexity of the regulation certainly adds to costs. There is a lot of uncertainty at the moment, which there always is with European regulation, and as we will definitely see in a couple of years, it will sort of sort itself out with the help of policymakers and the entire sector. But I think a strength that comes out of it is credibility. Because we have all those regulations, because we are very transparent and strict about what the standards are, we can credibly say that if you as an investor, either institutional or private, are buying a sustainable financial instrument in the EU, it is genuinely delivering on that promise of financing more climate-friendly projects. Two things happened recently, which I think are very good, but certainly the institutions involved don't see it that way. First of all, we saw a big decrease in the number of sustainability or ESG listed funds. Great. It was a result of higher standards, so issuers had to actually reconsider whether the funds are genuinely sustainable or are they in name only. The other thing is there was a Polish company which issued sustainability-linked bonds, and unfortunately they did not deliver on one of their climate KPIs, so their cost of capital was increased. Again, not great for this company, but in general, great. The system is working, the framework is working, so we as investors can be certain that when we buy sustainability-linked bonds in Poland and the issuer does not deliver on its climate objectives, there will be consequences. So I think we're on a great path to being the leader. We already are.
Lubomir, do you agree?
Well, I'm just wondering whether that actually is a question that we should be asking ourselves, because I think it, in a way, we see sustainable regulation all around the world, and because these things are not trying to resolve issue in a one particular geographic area, we're actually trying to resolve a global issue. So I think that it's good to have a leadership here and there and to come with ideas, and it doesn't matter actually where they come from, as long as they are adapted for the greater of the whole world. And I think that's from my perspective, or what I have seen is that the regulation is really coming from places all around the world, and it's enormous wave. And I think that sometimes some people think that it's only Europe actually trying to bring or impose the regulation on itself. And I think it's just a wrong optics because it's happening everywhere.
Certainly is. It's over 30 taxonomies in development internationally. Many of them are taking the EU as the kind of beginning boilerplate. So Martin, your opinion, will your policies deliver?
I spoke a lot. I will focus on the end because I agree that it's the end that matters, not whether we are leading or comparing ourselves with the UK. Well, I will tell you, I hope so, but I will tell you what the responsibility of the policymaker is and what the responsibility of the market is, because that will very much depend on the answer what we are going to do and what you are going to do. On what we are going to do is that I think that now it's the right time to stop legislating and regulating and rather focusing on, as I said, make it work on the ground and be there to support your implementation and clarify and be also open to hearing the challenges that you are facing and being able to resolve them. And I'm not telling you because I would like to be nice or this is in my political notes. This is really a genuine effort of the Commission. So those of you who are interested in the practicalities and the details, how this agenda can work, please reach out to me. This is what I am going to do for the next 15 months in my job. Now, there is another angle that Lubomir, you mentioned, which is the international. EU will not deliver on its own. We are obviously working with our international partners. We have already heard, I mean, what the other standard setters are doing. We need to work with the others and try to converge where we can. On the double materiality, we will not compromise. We will push our EU agenda very strongly, but there are ways where we can converge. Now, my second, and this is my final conclusion, is the impact that you will bring will be decisive here. So whether the policies will deliver, I cannot answer that. The answer is in your hands.
Excellent concluding point. Thank you, Martin. Thank you, all my panelists. Julian, Linda, am I handing over to you? Julian, go for it.
Did it work? Hello, good, working. Thank you so much, Nadia, for the masterful moderation here, and thank you all the speakers for joining the discussion. Really insightful and inspirational, as we hoped for. Now, we will take a short break. We are running a little bit on a delay here, but let's take maybe 20-minute coffee break, enjoy some coffee and refreshments in the hall, and then we will meet here in, let's say, 10 minutes, maybe after 11 for the second part of today, which will focus on ESG ratings and ESG data. So we'll see you soon. Thank you.